tech giants recently dropped their quarterly earnings. Both beat their revenue expectations, yet one stock surged 10% while the other was ruthlessly punished by the Wall Street. Let's look at the market divergence and why it happened. Amazon hit a rocket ship trajectory, crossing $200 billion in revenue as AWS growth surged over 37% year over year. Also raised their AI capex budget to a whopping $220 billion, which ended up in them reporting a negative cash flow of $8 billion. The stock flew 10% higher on the day of earnings. On the other hand, Alphabet crossed a revenue of $120 billion as their cloud business showed an 82% growth year over year. Alphabet also increased their AI capex budget to $205 billion, which ended up in a negative free cash flow of $6 billion. But in spite of showing similar earnings metrics as that of Amazon, Google's share price fell 7% on the day of their earnings. So why such a stark contrast? According to me, the variable that moved the stock price was not the size of their spending or the cash flow, but it was whether the company could show that the demand was locked in for their AI spending. Amazon's cloud backlog of signed contracts jumped over $132 billion, where Google's cloud backlog jumped over $50 billion. Additionally, Amazon wasn't betting on just one number. Its core retail business is still the significant revenue driver for the company, bringing in 80% of the total company revenue, and is still highly profitable. Ads also grew 26%, bringing in another $20 billion. AWS is still their margin engine, but it's three highly profitable businesses backing Amazon's $220 billion capex bet. Google, on the other hand, completely relies on its search and advertising machine, YouTube, for funding its AI ambitions. So it strongly looks like the Wall Street did not just buy into the AI hype, they bought into Amazon's safety net. Save this reel for more corporate entity breakdowns. I hope this helps.